Several years ago, there was a movie called It's Complicated. That's a good headline for GovCon M&A in 2026. It's complicated. To unpack the changing government contracting landscape, we've got Marty Brennan, Managing Director of Transaction Advisory Services with the strategy firm Deepwater Point. We're talking growth, risk mitigation, and what sellers and buyers need to know to win big in 2026.
This is GovCon M&A Talk, presented by Orange Slices. I'm Sharon Heaton of sbLiftOff, and I live and breathe GovCon M&A. So let's talk deals.
Marty, it's a pleasure to have you with us today.
Sharon, Happy New Year. Thank you for having me.
Truly my pleasure. Well, 2026 is going to be a very interesting year, but I'm not sure we can jump into it without talking a little bit about what happened in 2025. 2025 was a bit of a pivot year for GovCon. What did you see happening?
Well, I think it was unusual at best. um, it, and I would say that because usually the year following a presidential election where there's a transition of administration is usually a bellwether year for M&A within the government contracting community. We've seen that historically over the last 20 years, regardless of what administration and what party wins. But this year, or this past year, I think was a bit different in a few ways. And obviously, DOGE played a little bit of a role in this. The new administration, how they came in, played a little bit of role in it, played a role in it. But the reason normally it's a 4-year high is because there's typically clarity about the priorities of the administration. Typically, the president gets his budget in the first year or the first 2 years, and companies that are well aligned with those sets of priorities and have done their homework and done their preparation and have sort of lined up their contract renewals and the like are usually positioned for an exit. And I think not unlike prior 4-year cycles, many companies were lining themselves up for an exit this coming cycle, this past year, assuming they actually knew what was coming down the pike. And that clearly was not the case this year, at least the first half of the year was not the case. Now, we did have a few deals that closed out at the beginning of the year. Those were largely deals that came over from 2024, but there were a number of deals in cycle in early 2025 in process that just stopped. And the reason for that was, the Doge showed up, Elon Musk showed up. You had a number of new administration officials coming on board that had, I would say, very different views or very different approaches, much more disruptive approaches than had prior administrations coming in. And that Project 2025 roadmap, I think, really laid out some of the things that the administration has attempted and I think is accomplishing in some regards. And so that uncertainty, which typically is not baked into the beginning of a new presidential term, suddenly showed up. And the market hates uncertainty. And so, I mean, we found that clients who were getting ready to start a sourcing process to find new companies to buy, deals that were in process that had been queued up for banks to go, everything got put on hold. And it was frustrating. It was frustrating for the bankers. It was frustrating for the companies that were trying to exit. It was frustrating for advisors such as ourselves. And because of that uncertainty, nobody knew how to price a deal. And when you don't know how to price a deal, it's very hard for you to convince an investment committee, a board of directors, a financial sponsor of any kind to actually move forward. So we really did find that first half of the year just was it suddenly became an echo chamber as we were all waiting 3 months out for some degree of certainty to come about.
I want to emphasize what you just said. 2025 felt it was not 1 year, but two. That is January through, I don't know, May, June was kind of
Hmm.
year 1A. And there
Right.
was a lot going on, and there was total uncertainty. And the mental image I had was a deer in the headlights. Everybody was just frozen, saying, I don't know if I should go to the left or I should go to the right. We actually closed a deal during that time period, but it was in the IC. And I think everyone was kind of feeling like, yep, that makes a lot of sense. In contrast, we went into 2025 with a transaction that was a company been around for 20 years, had some nice EBITDA, all that wonderful stuff. They were in USAID. And not
Not a
surprisingly,
good
that
year to
deal
be in
did
USAID.
not in a good year to go into
No.
USAID. Then it felt like June, July, August, kind of people shaking it off a little bit. And the level of interest, September through December, seemed very high, particularly from buyers. Did you see that as
Absolutely.
well?
There was a lot of pent-up demand waiting for things to settle down. And I think in that time frame that you described, a couple of things happened. You had the passage of the big beautiful bill. So that provided some view and some certainty on funding priorities. You had Elon, who went back to the private sector. And a lot of the Doge activity, and there's still plenty of Doge activity going on today, but a lot of the sort of disruptive, upfront Doge activity started to settle down a little bit. It doesn't mean that there wasn't still disruption, but with that, I think that gave people some comfort that there was at least a view as to what areas were preferred, what weren't, what types of work, even within agencies and within certain domain areas, consulting work. And I'm a longtime management consultant. Our work is the work I used to do is very out of favor right now. Um, and so a lot of companies that did that type of work found themselves sort of in the wrong place. But those that were doing work in DoD, those that were doing work in the intel community around national security, national, homeland defense, those companies felt, I think, much more certain coming out, and the banks felt much more certain presenting them, and buyers felt more certain. I won't say they felt great certainty, but they felt much more certainty in reviewing and looking after and pursuing some of those targets. And there were a number of deals that closed that still got garnered a lot of interest over the past 6, 7 months. Many of them actually attracting multiple buyers, multiple buyer types. And you still had a number of deals that were closing at multiples that many felt were still pretty high, and all relative to some of the other ones. But I also think there was a tale of two cities in that, a good deal always gets done. A company that is aligned well with the administration priorities, that's well run, that has their contracts lined up, is always going to fetch a good price and is always going to be very attractive. But those that maybe weren't as well aligned, who still, had been doing good work, had had good revenue growth, had had good EBITDA growth, suddenly found themselves not rising with the other tides. And I think in the past, thinking 2021 in particular, that tide rose all boats. And so even, companies that I would say were, moderately interesting still fetched higher prices. And in this case, now there might have been fewer interests in some of the other companies outside of the ones that were perhaps considered the belle of the ball.
Let me follow up on what you're saying. For years, as we've been doing this kind of work, we want to look at your financials, we want to look at your backlog, we want to look at your pipeline, we want to look at your management team, all those kinds of things.
Hmm.
It feels to me that the agencies that you're in are far more important now than it has been before. It feels like this world is really divided into three categories. We've got the Department of War and the funding that's going there. We've got the intelligence community, and then we've got FedCiv. And FedCiv feels a little bit like the left behind child, a little bit, that a lot of the activity, a lot of the money, a lot of the focus is going on Department of War and IC and FedCiv a little bit less. Does that comport with your experience?
It does. Now, there are some pockets that, I think can still separate out a little bit. So within FedCiv, depending on how you classify Homeland Security, DHS has gotten quite a bit of attention and still is getting quite a bit of funding. And so there have been a number of companies that have a strong DHS portfolio, or at least within certain agencies, that has still been very interesting. There are other areas that from a priority standpoint, let's say FAA, for example, FAA modernization is getting a lot of funding, and still has a lot of attention. And so if you were engaged with or very well positioned around FAA modernization, there was still some interest in your firm. Didn't mean that you weren't still doing a lot of due diligence on that work, but you were still getting some attention. But all the things you've described earlier about the typical components of diligence, those matter, and those matter, I would say, even more so now. So whereas you might have had a more perfunctory diligence taking place, when you had a company that, all the growth factors looked good, the personnel looked good. You have boards, you have investment committees that are digging in a lot more, even on the Department of War, IC assets, because there still is some uncertainty. There still are some disruptions that are taking place with contract consolidation, with other things. So while DOW, while IC are well preferred and still are, and if you've got cybersecurity in there in the mix, all the better. And DHS, not every part of DHS, but a good number of parts of DHS. Yes, the market is still interested, and if you're trying to exit, I think you still have the opportunity to have a good story to tell.
Now, you represent mostly buyers. Is that correct? You basically buyers will come to you and say, "We want to find targets. Help us find the target." Um, it used to be going into January 1st of 2025 that if there was a company that had a prime contract with backlog, you were pretty confident that that backlog was going to get used. A little bit less so now.
That's
How do
right.
buyers want to restructure deals to deal with the uncertainty? And look, we're just talking about prime work right now. The uncertainty about buyers. How do buyers sell and how do sellers still get full value for their company in that process?
Well, and Sharon, you make a good point because we've had a couple of clients, not all on the buy sides, with other parts of Deepwater Point and Associates, who have found themselves coming up on an option year renewal, and the option year renewal didn't get renewed, and their performance was fine. Their client loved their work. It was on mission. It was within an area that was well funded, but they were finding that their money was getting reprogrammed to a slightly higher need, and maybe with a non-traditional contractor, a commercial contractor that may not have had as much favor in a prior administration. And so, yes, there is a degree of uncertainty that comes into play, not only with recompetes, which used to be considered pretty standard, but even on option years that are pretty important or pretty crucial to, the overall value proposition. And to that end, we have seen structure come into play in a number of instances. Structure always can play a role in a deal, but I think in 2025, and I suspect for 2026 going forward, we're going to have some sort of whether it's an earnout or whether it's a performance bonus, but some tie to a something that's critical. So, for example, if you've got a firm that has a key recompete coming up, normally you would wait until the recompete was behind you before going to market. But let's say it's 2 years out or 1 year out, or there's a key option year that's coming up a year or two from now. You might see a buyer setting aside a portion of a sale price as an incentive that specifically ties to that discrete act, right? That winning that award or winning the award at a certain value. And that's something that many sellers may have been a little hesitant to take in the past. But I think more and more you're seeing structure of some sort come to play as a means of de-risking the deal and getting the investment committee, the board of directors, comfortable that this makes sense, a lender as well.
The way in which we saw this at SB Liftoff was not so much shifting risk as sharing risk. That is, a seller would go to market and say, I have $120 million of backlog. And a
Hmm.
buyer would say, that's great, but that backlog doesn't appear.
Right.
So to do some structure that says, if you meet the backlog, if I can get the backlog that you said in your confidential information memorandum, fantastic. I'm going to pay you this, but I can't pay you all of that up front because I can no longer count that $120 million backlog will actually materialize. So we've been saying to sellers, buyers pay for what they get at closing. And then the risk of the government changing, shifting sands will
Hmm.
be shared between the buyer and the seller. Sellers, in our experience, tend to be very optimistic people. They have
Of
planted
course.
seeds. They are certain that these things are going to happen. And in the past, you could have greater certainty. If I recall correctly, and correct me if you see it differently, recompetes used to have like an 85% win rate. And then it went down to 65%. Now I think it's closer to 50. Auction years, if you were prime, 100% certainty. Now, I don't know if statistics would be reasonable to think it's 100%.
Yeah, and so when we're doing our due diligence work for our clients, honestly, we've always gone down closer to the 50% number when we're doing our independent estimates. And we've done this before this past year, in part because we saw greater competition coming through. We saw, if somebody's looking to grow their business in a world of continuing resolutions, there's a lot less net new work that is out there. And so the way you tend to have to grow your business is by capturing market share from somebody else. And so we have seen a greater, a higher scrum, if you will, of going after a recompete, especially with firms that may be coming out of transitioning out of a small status and trying to reposition their work as full and open, and might suddenly be attracting competition from places that they weren't expecting. Some of the larger firms are going after some of those lower dollar amount, that they might not have considered a few years ago, especially if it gives them past performance, if it gives them entry into a new agency or department, if it keeps people employed. I mean, that's, a fundamental thing that a lot of firms have been doing this year is just making sure they can keep their people busy. It's not ideal to just hold serve sometimes, but that does lead to higher competition. So the 50% to me is, and we get grumbling from, some of the targets when they hear we're doing that. But 50% may even be a little aggressive in certain places as well. But I agree. I think the idea of sharing risk, of making sure that they have some incentive that the selling company has some incentive to stay in the game and to make sure that they are continuing to delight their customers, stay ahead of their customer needs, uh, make sure that the acquisition strategies they're helping to shape those are all critical components to ensuring that your value as an organization post-deal continues to grow and grow at the level expected and the level paid for.
I want to go back to something you talked about into the market. And I have to admit, I don't fully understand it. We have this, again, prior years, there was the GovCon companies, there were the commercial companies. And now we have commercial companies coming into GovCon. Fantastic. But if they're going into the Department of War, how are they dealing with things like CMMC? How are they dealing with CMMI? Those things are not being waived, but I would imagine for a commercial firm, putting in a place of CMMC is going to be a very big deal.
Yes, and we're seeing CMMC has been a huge um, focus of firms out there, our clients writ large, not necessarily just those that are
Absolutely.
going
It's not just
through
an M&A.
M&A, although we are seeing in the merger integration space a strong focus on how do I align my different postures coming in and what posture do I need to take. But your point about, commercial entrants. This is something that in the new acquisition memo that, Department of War Secretary Hegseth put out on November 7th talked about attracting, commercial companies into the space and using new vehicles and new ways of getting in. So OTAs, SIBRs, and the like, as means, as easy buttons, as ways to help. I hate to say short circuit, but shorten the procurement process and sort of move to alternate acquisition processes.
Now
Um,
that makes sense, but a question for you is, do those firms coming in, shortened acquisition process, all on board, are they still required to do DCAA audits? Are they required to do CMMC? The kinds of things that a GovCon company has spent a lot of time standing up, are they now competing against commercial firms that don't have those same obligations?
well, that is indeed, I think, a fair question. I think on CMMC, I think the storybook is still out a little bit because I think everyone's getting their arms around CMMC. But if you have a company that's going to come in on a firm fixed price basis, you may not have to, adhere to, and I'm not the DCAA expert here, but I think there are ways to get around that, and I think the federal government is certainly looking for ways to shorten the acquisition cycle. And in fact, we are starting to advise companies, not my group specifically, but broader Deepwater Point and Associates are starting to advise companies on the new acquisition guidelines as they're coming out. And as they are going to be promulgated, the principles have been promulgated at this point. I think the particulars are going to be promulgated, I think, through May. So over a sort of a 6-month time frame. And I think we'll have greater clarity as to some of those piece parts. But it's pretty clear right now that commercial companies are being invited in, and I will say going around or bypassing a lot of some of those requirements through some of those alternative contracting authorities, through OTAs and the like, in a way that, no, I think the goal is to get them to, again, sort of skip some of those requirements or bypass some of them where it's viewed as in the national security.
Tell me about your clients. What are your clients looking to buy?
Oh, they're all looking to buy the same thing. They're looking to buy somebody who has a presence in DoW, the IC. They've got cyber. They're mission focused. They're doing firm fixed price work, and they all want them at discounts.
Yes,
So it's
I call it looking for the purple unicorn that flies. You've got
that's
to have a
right.
company that's this size, has these margins, has this backlog. By the way, can I pick it up for a 4 multiple? No,
Yeah.
you cannot pick that up for a 4 multiple. That's not going to happen.
Yeah. So I mean, I joke a little bit, but to be fair, that's where people are looking in those areas because those are areas that are expected to continue to be funded throughout this administration. A national security footing, something that's solution focused versus delivery of hours, if you will, something that is, are tied into I think there are a number of critical technology areas that have been discussed and promulgated, hypersonics, directed energy, solution sets around those. So if you have, companies that have been investing in those spaces who have, maybe haven't come up with a full solution set yet, but, who might be attractive to an organization that knows how to navigate the federal government, that knows how to that has a set of customers that are looking for some of those capabilities. Suddenly, those firms become very attractive, and we've heard about those repeatedly in the investment banking circuit. A lot of our friends on that side are talking about the importance of defense tech into the space. So certainly, if there are firms that have that experience, they're of interest. We have heard some of our clients, talk about how they can bring commercial best practices into their customer sets to help differentiate them, or at a minimum, insulate them a little bit from looking like what we might otherwise consider a more traditional, contractor a couple of years ago. We talked about a couple of the alternate acquisition avenues before. Companies that have a phase two or a phase three SBIR, who have some experience marketing it out, who have a sponsor. Um, Buyers are much more sophisticated these days, and a couple of years ago might have looked a little askance at those or not sure how to value those. And I think buyers are, especially those that have done a lot of work in the federal government space, I think understand that and understand that that can be more of an easy button to go after. OTAs, another example of that again, because that provides a quicker time frame to contract, a quicker time
See,
to
I think there is a difference between the two things you just mentioned. An
there are.
OTA contract and gets you there faster. Fantastic. The
Yep.
SIPR indicates that the government thinks that your technology or process or whatever it is cool. They think
Hmm.
that phase one, it's very nice to have a phase one, but we're really talking about phase two and, hitting the home run of a phase three. It
Right.
used to be that I would think that buyers look at SIPR phase two or three and say, well, it's not a lot of revenue. So I'll give it some value, but not a lot. It feels to me like those are going to become more valuable. And it's not simply going to be how much revenue, what's the profit, we'll do all of that, but rather that is in its value that could be a kicker for that seller.
That's right. And we are seeing again with that more sophisticated buyer and their financial buyers, financial investors who have experience now. Some have even exited firms with substantial SBIRs. And so they are much more comfortable looking and at what the potential for that could be. What modifications they might be able to make, what extensions they might be able to make as a way. They might have their own experts that they can bring in specifically to help the organization to take advantage of it. Or, which is something that's also very important, how do you market that SBIR to other agencies and other departments outside of where you initially started your work? I mean, DOW has been very familiar with this space for a long time, but DHS also procures a lot of work through SBIR vehicles, is very comfortable with it. We did a survey for one of our clients. It's a little stale, but probably over a year ago, and we had at least 15 agencies that had procured using SBIRs. It's some level of value, and I think a number of our clients saw that as opportunity to go market, in particular, even some federal civilian agencies who could go there. Because if you can get to an easy button, and if you can avoid having to go through a protracted procurement cycle where you have lots of eyes looking in on and maybe some different views on what vehicles should be used, whether consolidation should take place or otherwise. Again, it's a speed to revenue, and if you can increase the speed to revenue, that's speed to increase valuation.
Absolutely. Marty, I really want to thank you for your time. It's going to be a pleasure working with you in 2026. I'm sure we will. Any final comments from the audience of what you're seeing in 26?
Well, I think we're seeing, or I think we believe there is going to be a strong 2026 from an M&A standpoint.
I agree.
Not to the 2021 levels, probably, but I think there are a good number of companies that are ready to come out. You talked about buyers. There are a lot of people that are very interested in bolstering, in maybe replenishing, some of their revenue, in finding ways to sort of expand to other agencies and other customer sets. And so I think there's a desire on behalf of both buyers and sellers to get some deals done in the coming year. And I think what's going to be important is for those companies that are preparing for an exit, number one, to be able to have a good story to tell. If they haven't been able to pivot from maybe some troublesome or challenging areas, get that strategy in place now. Start working on that pivot. Start focusing, make sure that you're showing you're pretty agile in an uncertain market. And that should help position you, whether it's for 26 or 27, to exit and to exit maybe in a manner that you would prefer to do so. And so I think it's still, things haven't smoothed out entirely yet. We still have to get through another budget component at some point. There may be a few of these continuing resolutions that take place, but I think good companies are still going to attract a lot of attention. So do what you can to position yourself as one of those great companies that attracts a lot of attention. Line yourself up against the administration priorities. If you aren't, pivot to those that are. Look for some other ways to speed the way that your customers can get to you, and make sure you're leaning in on those capabilities that are aligned with the current administration. If you can do all those, then I think you're well positioned to really show that that possibility for value accretion.
Fantastic. Thank you so much for your time, Marty.